Most people think the most powerful person in the world sits in the Oval Office. They think the president controls the economy, controls their mortgage rate, controls whether their 401k goes up or down, and they are wrong. Completely, dangerously wrong. The most powerful unelected individual in the global financial system is the chair of the Federal Reserve. Right now, that person is Jerome Powell. And with a single sentence, a single press conference, a single adjustment to a single number, he can add or erase trillions of dollars of wealth from the global economy within hours. Not days, hours. If you do not understand what the Federal Reserve is, how it operates, and why its decisions are the single most important macro variable for every investment you own, then you are not an investor. You are a passenger, and passengers do not build wealth. They just ride along until someone else decides to stop the car. Let me tell you something I learned early in my career when I was building SoftKey and navigating the capital markets for the first time. I was focused on everything I thought mattered: product quality, sales growth, customer acquisition. And a mentor of mine, someone who had been operating in financial markets for 20 years longer than I had, sat me down and said, "Kevin, none of that matters as much as the direction of rates." I didn't fully believe him at the time. I do now, because once you understand the Federal Reserve and the mechanism through which it controls the cost of money, you realize that every other variable in investing is secondary. Earnings matter, management quality matters, competitive moats matter, but they all operate within a framework that the Fed sets. And if the framework is hostile, even great companies struggle to produce great investment returns. So let's start from the beginning, because I am not going to assume you know this. The Federal Reserve is the central bank of the United States. It was created in 1913 following a series of devastating banking panics that exposed how fragile the American financial system was without a lender of last resort. The Fed is structured as a quasi-governmental institution. It has a board of governors appointed by the president and confirmed by the Senate, and it operates 12 regional Federal Reserve banks across the country. The most important decision-making body within the Fed is the Federal Open Market Committee, the FOMC, which meets 8 times per year to set monetary policy. Every one of those meetings is a market event. Every statement, every press conference, every word Jerome Powell chooses in front of cameras is analyzed, dissected, and traded against by the most sophisticated participants in the global financial system. If you are not paying attention to these meetings, you are operating with a material information disadvantage. The Fed has what is called a dual mandate. Congress has instructed it to pursue 2 objectives simultaneously: maximum employment and stable prices. Stable prices means controlling inflation, with a long-run target of approximately 2% annual inflation. Maximum employment means keeping unemployment as low as possible without triggering the kind of wage price spiral that feeds back into inflation. These 2 objectives are frequently in tension with each other. When the economy is running hot, unemployment falls, wages rise, and inflation builds. When the economy is cooling, unemployment rises, spending falls, and inflation softens. The primary tool the Fed uses to navigate this tension is the federal funds rate, which is the interest rate at which banks lend money to each other overnight. That rate is the foundation upon which virtually every other interest rate in the entire economy is built. Here is how the mechanism works, and I want you to understand this precisely. When the Fed raises the federal funds rate, the cost of borrowing increases across the entire system. Banks pay more to borrow from each other, so they charge more to lend to businesses and consumers. Your mortgage rate goes up. Your car loan rate goes up. The rate that corporations pay to issue bonds goes up. The credit card interest you're ignoring because you're making minimum payments gets even more punishing. Every single leveraged position in the economy becomes more expensive to maintain. Businesses that were planning to borrow to expand now reconsider. Real estate developers who are planning to break ground on new projects run their numbers again, and many decide not to proceed. Consumers who are on the edge of buying a house at a given monthly payment find themselves priced out. Economic activity slows, spending contracts. And as demand falls, the price pressures that were driving inflation begin to ease. That is the transmission mechanism. That is how a 0.25% change in an overnight lending rate between banks eventually shows up as a higher monthly payment on your mortgage and a lower valuation on your growth stocks. Let me now explain the valuation impact directly, because this is where most retail investors have absolutely no idea what is actually happening to their portfolio when rates move. When a Wall Street analyst values a company, particularly a high-growth technology company, they use a model called discounted cash flow analysis. The idea is straightforward. A company's value today is equal to the sum of all the cash flows it will generate in the future, discounted back to present value using a rate that reflects the time value of money and the riskiness of those future cash flows. That discount rate is heavily influenced by interest rates. When rates are near zero, as they were from 2008 through most of 2021, the discount rate is very low, which means future cash flows are worth nearly as much as present cash flows. A company that is losing money today but is projected to generate enormous profits in 2030 looks extremely valuable because those 2030 profits, discounted at a low rate, are worth a lot in today's dollars. This is why the zero-rate environment produced the extraordinary valuations we saw in unprofitable technology companies. The math supported it, given the inputs. Now raise rates from near zero to over 5%, as the Fed did between 2022 and 2023 in the most aggressive tightening cycle in 40 years, and the math changes brutally. Those same future cash flows, discounted at a higher rate, are worth dramatically less in today's dollars. The duration of the asset, meaning how far out in the future its cash flows are, becomes a liability rather than a neutral factor. Long-duration growth stocks get repriced down, hard and fast. This is not a sentiment story. This is arithmetic. When you understand this mechanism, you stop asking why your favorite unprofitable technology stock fell 60% in 2022, despite the company still growing its revenue at 40% per year. The revenue growth didn't change. The discount rate did, and the discount rate is set by the Fed. I want to talk about the yield curve now, because this is one of the most widely watched and historically reliable indicators of economic stress that exists in the public domain. The yield curve is simply a chart that plots interest rates on U.S. Treasury bonds across different maturities, from short-term 3-month bills to long-term 30-year bonds. Under normal conditions, longer maturities carry higher rates than shorter maturities because investors demand more compensation for locking up their money for longer periods. When the yield curve is steeply upward sloping, it generally reflects a healthy expectation of future economic growth. When it flattens or inverts, meaning short-term rates exceed long-term rates, it typically signals that the market expects the economy to weaken and that the Fed will eventually need to cut rates to stimulate growth. Every major recession in the United States over the past 50 years has been preceded by a yield curve inversion. Every single one. That is not a coincidence. That is a systematic signal embedded in the collective expectations of millions of market participants. Ignoring it is something I am simply not willing to do. Now let me explain the Fed dot plot, because this is a tool that too few retail investors are even aware of, let alone using. 8 times per year, when the FOMC meets, the Fed publishes what is called the Summary of Economic Projections. And embedded within that document is a chart that shows where each individual Fed member expects the federal funds rate to be at the end of each of the next several years. Each member's projection is shown as a dot on the chart, hence the name. The median of those dots is the market's best publicly available signal of the Fed's intended rate trajectory. When the dot plot shifts upward from one meeting to the next, it signals that Fed members collectively expect rates to stay higher for longer than previously anticipated. When it shifts downward, it signals an expectation of cuts ahead. The bond market, the currency market, and equity markets all respond to dot plot movements in real time. The professional investors I respect spend considerable time analyzing not just where the dots are, but how they are moving between meetings and whether Fed communication is consistent with or diverging from the dot plot guidance. Here is the strategic implication, and this is the part that should directly influence how you are positioning your portfolio right now. There is an old Wall Street maxim: do not fight the Fed. It is old because it has been proven correct over and over again. When the Fed is in a tightening cycle, raising rates to cool inflation, the systematic pressure on risk assets is real and sustained. Fighting that pressure by loading up on long-duration growth stocks or highly leveraged real estate speculation is not investing. It is stubbornness dressed up as conviction. In a tightening environment, capital gravitates toward shorter duration assets, toward dividend-paying value stocks, toward treasury bills that are suddenly paying meaningful yields for the first time in years, and toward sectors like energy, financials, and consumer staples that have pricing power and do not depend on cheap borrowing to drive their business models. Conversely, when the Fed pivots and begins cutting rates, the signal reverses. Duration becomes your friend again. Growth stocks, which had been penalized by high discount rates, begin to recover as the math improves. Real estate, which had been suppressed by high mortgage rates, starts to breathe again. The investors who correctly anticipate the pivot and position ahead of it capture the most significant gains in the subsequent cycle. I have seen investors lose decades of compounded gains by refusing to respect the macroeconomic environment the Fed creates. They hold their positions based on company-specific conviction, while the entire rate regime is working systematically against their thesis. Money has no emotions, and the Fed certainly has none. It is operating a policy mandate, not a personal favor to retail investors. The sooner you internalize that the Fed is the gravitational force around which all asset prices orbit, the sooner you will stop making portfolio decisions in a vacuum and start making them within the proper macro framework. Understanding the Federal Reserve is not optional for serious investors in 2026. It is foundational. The next FOMC meeting will move markets. The next dot plot release will shift bond prices globally. The next Jerome Powell press conference will be parsed word by analysts managing billions of dollars of capital. You can either be informed and positioned, or you can be surprised and reactive. I know which one builds wealth and which one destroys it. The Fed meeting is coming. Are you prepared for a pivot, or are you still fighting the trend? Tell me your prediction in the comments. Check the link in the description for my full macro cheat sheet to navigate the next rate cycle. Subscribe to InvestIQ Global. Understand the system, then beat it.